So, just want to welcome everyone and thank you for coming and joining us today. Special thank you to TCV, who's not only providing our presentation today, but also sponsoring the event. So we appreciate them setting this up for us. The purpose of this installment of the Financial Wellness Series is to take a journey through different retirement plan options in the event your solo or small firm begins to grow, or if you find yourself in a management situation at a larger firm and you're faced with assisting the firm choosing between retirement plan options. So we hope after this presentation, you'll be better equipped to evaluate the retirement benefits available for firms in order to help both you and, if applicable, your employees save for their future. A quick reminder, Q&A will be available. Just put it in the chat box. And if for some reason we can't get to all of them today, we'll reach out. We'll have a list of the questions and get them answered for you. So guiding us through this journey today, I would like to introduce George Gilliam of TCV Trust and Wealth Management. Prior to joining TCV Trust and Wealth Management, George operated his own law firm and practiced in the areas of estate planning, estate administration, and business law. He is a Knoxville native and earned his undergraduate degree from the University of Tennessee and his Juris Doctor from Lincoln Memorial University's Duncan School of Law. George?
All right. Well, thank you, Daniel, and thank you to the KBA for allowing me to speak to everybody. So I want to make sure that we cover as much as we can. If there are questions, drop them in the chat and hopefully someone will alert me. As we move through this, I also want to give a quick disclaimer that we are only meeting for 1 hour and that this is general advice. There's a lot of different types of accounts that we're going to cover, and not all of them may be the best fit for you. So I'll kind of harp on this throughout this presentation. Always consult with a CPA or accounting firm, decide what type of retirement strategy is going to work best for you and best for your firm. And so as far as retirement accounts, there are about as many options as there are stars in the sky, it seems like, when you're doing your own research. Broadly speaking, you can define them into larger categories, namely IRA-based plans, defined contribution plans, and defined benefit plans. And within IRA-based plans, we do have a few different options. Defined benefits, when you think of that, usually think 401k is what we're going to be talking about today. And for the defined benefit plans, those are a little bit rarer. But all of these terms are nice and good. What is really the difference between these? And so with IRAs, of course, that stands for individual retirement account or individual retirement arrangement. And that is generally where the employee, sometimes the employer, deposits funds on the employee's behalf. And then at the time of distribution or withdrawals, the IRA is essentially made up of the contributions and either the earnings or losses of those funds as they're invested. The defined contribution plans are fairly similar, but they are always employer established. So with IRAs, you do have some options where it's just the employee doing it. Defined contribution plans are always the employer, and they don't have a set benefit. Instead, they work similar to IRAs, where it's just made up of contributions and then the either appreciation or loss of any investments. For defined benefit plans, this is one that we're going to spend the least amount of time on today. This one is very rare from what I was able to do and find in my research. So it is where a specific benefit is promised, generally a specific dollar amount based off of the years of employment and terms of the plan. It has nothing. It is completely separate from investments and contributions, which is why it's great if you're an employee, you're going to get it. If you're an employer and you're having to cash out money that you may not have, it might not be as joyful to you as you're going through it. But we're going to kick off with IRAs today. And I should say, for all of these, at least for IRAs and defined contribution plans, we're going to go through each one by one. And I'm going to give a summary of the differences and then a short list of pros and cons for them as well. And so for the payroll deduction, it works very similar to a traditional IRA outside of businesses. The employee is the one that makes the contributions through payroll deductions, and there's no annual filing required for employers. So that is something that you may want to keep in mind. A lot of these differences will come into play based on what you may find the best fit for your firm. I'll try and point them out as we go through. It also does have contribution limits. Those are the same as just a traditional IRA outside of businesses. And everything is vested immediately. And what that means is as soon as funds are paid into it, those funds belong to the employee. They get the benefit of it. So there's no time period that has to pass or anything like that, hoops to jump through for that money to be vested in the employee. And this is probably the simplest type of account that we're going to talk about today. It's also very flexible because there's no mandatory contributions. You can contribute as you see fit within the contribution limits that we had just mentioned. So it was about 7,000 with some catch-up provisions, what they call catch-up provisions. If you're over a certain age, they're saying, okay, you might need a little bit more money to contribute so that you can be ready for retirement in time. Few cons is that contribution limit. So it's nice that you have some flexibility in when you can contribute. Let's say cash flow is doing well, everything's going well, and you want to contribute more. You're kind of deadlocked in based on that contribution limit, and there's no room for employer contribution. So it's the employee doing all of the legwork there. That is in contrast to the SEP IRA, stands for Simplified Employee Pension. And in this scenario, the employer is the one that sets up the account. It does require an annual filing to set it up, but then no filing requirements after that as far as annual filings. It does also have a contribution limit, but it is much higher potentially than the payroll deduction IRA. So it is either 25% of employee pay or up to $69,000. So, and it's the lesser of those two numbers. So generally speaking, it will be a higher contribution limit than the employee's option in a just a traditional IRA or payroll deductible IRA. And similarly, it also vests 100% at the time that contribution is made. So this is probably one of the ones that new attorneys, solo practitioners lean towards a lot because they're easy to set up and maintain, not a lot of hoops to jump through. It shares the flexibility of the traditional IRA, payroll deductible IRA, but the contribution limit is much, much higher. Now, the employee cannot contribute, but if you're something like a solo practitioner, where really the funds are kind of coming from the same arena, it may be a very good option. Now, if they're not coming from the same arena, if you're just an associate or something like that, do keep in mind that contributions from the employer are not guaranteed. It is up to them. So it depends on what lens you're looking through for a lot of these things. If you're looking at it as an employer or an employee, you might notice moving forward that the pros and cons might switch depending on what lens you're looking at things through. The last IRA-based plan is going to be your simple IRA. Again, this also requires an annual filing to get it set up, but does not require a lot of work moving forward once it is set up. Contribution limits for employees is $16,000, and that's taken directly from the employee salary. And the employer must, and I've bolded the word must, match the employee contribution either by 3% of the compensation or a fixed rate of 2% for all eligible employees. And so if the employee chooses not to contribute, then it's at 2%. Contributions, once again, are also vested at the time that the contribution is made. And for these, that goes for both employer and employee contributions. So both of those are vested. The key thing with this one is the employer must contribute. So with the payroll deductible IRA, it's the employees may. For SEPT, it's the employers may. For this one, the employee may contribute, but the employer must contribute. And so try to keep that in mind. One of the things that we're going to touch on later is cash flow. So if you're a new firm and your cash flow is a little tight, keep in mind of the mays and the must, because that might make it either tighter or might even push you over the edge from being in the green to being in the red. And of course, we never want that to happen. And so these accounts pros also fairly easy to set up. Most of the work is done on the front end. And then the enrollment for employees can be automatic. And the employees, he does give them an opt out, then that's something that they can do, or they can just reduce contributions. It's really up to the employee. One of the biggest pros of this versus the other ones is you can't have two sources being contributors. You can have the employee contribute as well as the employer. So that's two extra hands putting money into the pot for you. The cons are the salary reduction method. That might not be ideal for some employees. It's case by case. The mandatory employer contributions, if you are looking at it as the employer, keep that in mind. That might not be a good thing for you depending on your cash flow. And then one thing which it's rarely applicable to most folks that take advantage of this, but I did want to mention it, is that it is only an option for companies with 100 or fewer employees. Most law firms, most folks watching this, that will not apply to. But if for some reason, we have a big law firm tuning in, which welcome, please keep that in mind if this is an option that you're considering. And so those three account types that we just went over, payroll, deduction IRA, SEPT IRA, and simple IRA, those are all of the IRAs. Now, there are other options, and there are Roth options that we'll talk about later. But for purposes of this presentation, those are the three most common types that employers will look at. And so we're switching gears here a little bit, and done with the IRA plans, we're going to move on to the defined contribution plans, which really consist of profit sharing and then your 401ks. And so for the profit sharing, this is where you'll see in 401ks, employers are usually the ones making the contributions, at least in part. And so profit sharing is no different. The employer is the one that makes the contributions based on the terms of the plan. And that's another thing that I want to pause and point out. Profit sharing and 401ks are generally defined by a plan that is written by the employer. And the terms can vary wildly as far as when withdrawals are made, if loans can be taken, when things are vested, things like that. Now, things like contribution limits and those types of items are fairly well set, but the terms of the plan are things you still want to pay attention to, whether you're drafting them as the employer or you're reviewing them as the employee looking to potentially sign on. And so there is no model form. Everything is based on how it is drafted. And I do recommend that you either get advice from a attorney or a financial institution to set everything up correctly. These do require annual filings as well. So where the IRA-based plans didn't require any filing after it was set up, these do in order to keep them in good compliance. And for profit sharing, contribution limits are either the lesser of 100% of the compensation or $69,000 for 2024. And the employer can deduct those amounts as well, at least up to 25% of the aggregate. So for an employer, this is something you want to keep in mind moving forward as well. Yes, I might have to pay, but it might also be a tax write-off. So, and that actually goes into our first pro, is that deduction can be very valuable. If you're looking at the taxes, you're meeting with your CPA, halfway through the year, you're doing good, but you have a big profit, which sounds nice to new attorneys, but then when you get in a few years and you realize, I have to pay for that, you might change your tune. And so that can be a great benefit for employers. It can also be very flexible for the employer. There's no mandatory contributions. As it states, you can have it be made as an incentive. So in the terms of the plan, you can say that if you meet this goal or if we meet this goal, then this type of contribution is made, whether that be profit, whether it be retention of employees who have been there for a certain amount of time, they can opt in, whatever it can be. It can act as an incentive. For the cons, while the employer has some flexibility, the employees might find that a little bit inconsistent. And so for them, it's not necessarily a sure thing. The amounts can change from year to year. There might not be a distribution or a contribution that year. So that's something that might be a turnoff for them. It may also not vest immediately, where the IRA plans, as soon as that money was put into the pot for an employee, it was theirs. Here, they might have to stay there for a certain amount of time at that company in order for it to vest, or they might have to reach another goal. And I want to pause for a minute. We do have a question sharing in the name, but it seems to operate like a 401k. So let me read this out. So my employer's plan has a quote profit sharing in name, but it seems to operate like a 401k with employee contribution and employer match. And then the profit sharing contribution is extra. Can they be combined? And that's a good question. So I don't necessarily know about them being combined, but you can have more than one. So you can have a 401k and you can also have profit sharing. And it depends on how the plans are written. They might go into the same pot, or it might be separate. Profit sharing can be distributed potentially from year to year. It might not always be a retirement vehicle. And so depending on how they define profit sharing, for this presentation and our purposes, it's defined as a retirement vehicle, but it's not always treated that way. And so based on the question, it sounds like what you may have is a 401k, and then in addition to that, a profit sharing model as well. So I hope that answers the question. You can mix and match these to a certain extent and have multiple models. One other con is that it also increases the complication for the administration. Now, that basically comes down to setting up the plan and doing an annual filing, whether that is over the threshold for what you are willing to do. It depends solely on you and your circumstances. But that is something to keep in mind, that it is an extra hoop to jump through. And speaking of 401ks, a good segue is there's a few different types that we're going to go through. Going back to the first slide, the major one that we have that most people think about is their traditional 401k. And that is where the employee can make salary reduction contributions, and the employer can also make contributions. There's no, similar to profit sharing, there is no model form for this. So when you're setting it up, get the advice of a financial expert or an attorney to make sure it's set up correctly. One important point on the traditional 401k is that it does require one extra step compared to the others, and that is the annual non-discrimination testing. And that is to make sure that highly compensated employees are not being favored over their lower compensated counterparts. And I'll explain why that is here in a minute. It also requires a similar annual accounting or filing, excuse me, to the profit sharing. And so for contribution limits for employees, employees and employers both have different contribution limits for this. So for employees, it is up to $23,000 for 2024. Or if you're over the age of 50, you do have what they call, again, catch-up provisions. You can contribute an additional $7,500. For employers, employers may, again, may is bolded, so keep that in mind, may contribute the lesser of 100% of the compensation, or $69,000 for 2024. And the employer can deduct up to 25% of that. So we'll get into the pros and cons here in a minute. But for vesting, the employee contributions immediately vest. The employer contributions, similar to the profit sharing, may vest over time according to the terms of the plan. So it's kind of a mixture there of profit sharing, and maybe an IRA is a potentially good way to think about it. But going back up to this annual non-discrimination testing. So with both of these, allowing for both employees and employers to contribute, traditional 401ks are different in that there is no joint contribution limit. They each have their own separate contribution limits, but there's no cap for joint contributions. And so that ultimately leads to higher compensated employees potentially being able to invest a lot more than their lower compensated counterparts, is how the math works out. So that's something to keep in mind. Now, if you're at a small company, might not be as applicable. But for you medium-sized firms, or even firms that are growing, that you might be looking towards this in the future, is something to keep in mind. For pros for a traditional 401k, the deduction, again, is very nice. It sounds, the contribution, spending that money, some people kind of grimace at it when they're new, but it can add up. And to be honest, I'd much rather spend the money on employees than having that money go toward taxes anyway. So that deduction is nice. Depending on the terms of the plan, it also provides flexibility when cash flow is tight. Again, that contribution for the employer is a may, it's not a must. So they have some flexibility in that. And then because you have two parties contributing, in the long run, you might be able to make out with a bit more money for the individual, that is. For the cons, again, depending on the lens you're looking through, a con for an employer might be a pro for an employee, and vice versa for an employer. Contributions are not guaranteed, and the plan terms can vary wildly. So if you're looking at it as an employee, that's something you might want to think about. If you're looking at it as an employer, you're thinking, good, that gives me some flexibility. The employer contributions may not vest immediately. Similar to profit sharing, there might have to be a period of time that passes, or an event or other criteria that come into play in order for the employer contributions to vest. And then lastly, we'll have a more complicated administration when compared to IRA-based plans. And I'll add in other 401k based plans. And it's really because of that annual non-discrimination testing. Next type of 401k that we have is the safe harbor. And the main difference with this and the traditional 401k is that you'll see on the second point, it does not require the annual non-discrimination testing that the traditional does. And that's for a few reasons. So going to the contribution limits for employees, very similar, actually, I'm pretty sure identical to the traditional 401k. contribution limits as well as the catch-up provisions. The key difference is that you have a mandatory employer contribution of either a specified matching contribution or 3% to all participants. You also have joint contribution limits. So whereas a traditional 401k, there is no joint contribution limits. The contribution limits were independent for employer and employee. Safe Harbor has joint contribution limits. And that says it cannot exceed either the lesser of 100% of the compensation or $69,000. And again, the employer can still deduct up to 25% of that, but that joint contribution limit is what makes it a little bit more applicable, or I'll say less favorable to high earning employees. A lot of folks look at it as a little bit more fair. And so another bonus for the employees is that employee contributions and required employer contributions immediately vest. So you get those employer contributions that are mandatory, those just as your contributions vest, they also vest immediately. Any additional employer contributions, if they go above and beyond, let's say, the mandatory, then those may vest over time, but you still have that set benefit of having the vesting occur simultaneously to your own contributions. And so I'm trying to keep track of time, making sure we're moving smoothly here. For Safe Harbor, again, you have that deduction for employers. They're also easier to administer when compared to traditional 401ks because they avoid that non-discrimination test. And from an employee standpoint, they allow contributions from both employer and employee. So again, you're doubling up on the money that you can acquire. Cons for the employer, contributions are mandatory and they're fixed. So if for some reason cash flow is tight, this is something that you want to keep in mind for an employer standpoint. Those are mandatory. So if either cash flow is tight right now, or you foresee cash flow getting tight moving forward, let's say your overhead, your profits are razor thin, this is something to consider. And it will still have, even though it's simpler than a traditional 401k, it is still more complicated than the IRA-based plans. Okay. The last type of 401k that we're going to go over today, and again, y'all, there are additional types of 401ks and additional types of IRAs. We're hitting just a few. So, this is not the end all be all. I do encourage you all to do your own research and talk with either a CPA or financial expert to figure out what's going to work for you. But for the last 401k that we're going to touch on, very similar as far as how it works for the employee contributions. Those limits are exactly the same. With this one, it may require the non-discrimination testing. And that is because the employer, it's this fourth bullet down, the employer may make the contributions. So unlike going back to the Safe Harbor, the must, this one is a may. The difference between the automatic enrollment 401k and the traditional 401k is the automatic enrollment does have that joint contribution limit. So it's kind of a hybrid between the traditional and then the Safe Harbor 401ks. But joint contribution limits are actually the exact same as the Safe Harbor. So like I said, it is kind of a Frankenstein. And as long as you have good employee participation, you can generally get away from that non-discrimination testing. That's why it's a may. If you have low employee participation, it's a hoop that you may have to jump through to make sure that the few that are participating aren't the high net worth earning employees that you have, if there are any. And so similar to Safe Harbor, employee contributions vest immediately. but the employer contributions may vest over time. And actually, I misspoke. That is more similar to the traditional 401k, not the safe harbor. Pros, and I know, I apologize, this may get repetitive. That deduction, it matters. Take it into account if you're an employer. They are easier to administer than a traditional 401k, and you still may be able to get away from that non-discrimination. So keep that in mind. Again, allows for contribution from two parties, employer and employee. And then it does not require contribution limits from the employer. So you're the employer looking at this, might be a good idea if cash flow is tight, or if the way that you run your firm means that having permissive ability to make contributions works best for your business strategy. Cons for the employee, some employer contributions may not vest immediately. So you want to make sure as you sign on to this, if you're an employee, you read the terms of that plan and figure out when the point that those funds vest in you is. Is it after a certain amount of time? Is it after a certain event? What happens? And even though it can be simpler than the traditional 401k, it is still more complicated than the IRA-based plans, because all of these 401ks still require annual filings. Even if it's not the annual non-discrimination testing, you still have to file the form 5500. So something to keep in mind. And because a lot of folks, the IRAs are typically fairly easy to kind of keep in their own lane, the 401ks are generally the ones that get confusing. Just a little cheat sheet here. So for employer contributions, they're mandatory for the safe harbor, and they're permissive for traditional and automatic enrollment. For the non-discrimination test, it's mandatory for traditional 401ks and permissive for safe harbor, and sometimes permissive for automatic enrollment. I also wanted to try and streamline who can make distributions. And for this chart, note, it is not who must make distributions, it is who can or may make distributions. So for employees, it is just the payroll deduction, IRA. For employers, it is just the SEP and the profit sharing models. For the simple IRA and then the other three 401ks, potentially both employer and employee can contribute to those. So if you're wanting to double dip, that's something to keep in mind. All right, so we've talked about the overview of all these accounts. That's great and good. But the whole purpose of these accounts is to set you up something for retirement. So the real question is, what happens at the end of the day? When can I get this money that we've been pouring in? And so withdrawals are permitted almost any time, subject to federal income taxes. If they're done prior to retirement age, 59 and a half, they may also be subject to 10% withdrawal penalty. That penalty can be waived in a number of situations, and that is all dictated by the IRS. So it's either the death of the account holder, disability, first-time home buyers get a pass for a little bit, health insurance premiums while unemployed, things like that. And these are IRA-based plans as well. I should have said that up front. So these are just the details on the IRA-based plans. And it also has participant loans are not permitted, so you can't borrow against your IRA. Draws on the defined contribution plans. So for these are the profit sharing and the 401ks. Withdrawals are permitted after a specified event according to the terms of the plan. So again, if you're an employer, draft the plan carefully. If you're an employee, read the plan carefully. And you want to make sure that you understand when you can get these funds. Is it based on age attainment? Is it based on retirement? When can you get the money that you've been putting in? And depending on the these withdrawals may still be subject to federal income tax even after these events, because you get the deduction on the front end. It may also allow you to take a loan out or do a hardship withdrawal, depending on the terms. So, unlike the IRA based plans, you can build in a little bit of flexibility with the defined contribution plans because you write the plan terms yourself. It's not dictated as heavily by the IRS. And early withdrawals will be subject to additional taxes. So you still want to wait for, ideally, when you can take the funds based on the terms of the plan. But if need be, defined contribution plans are a little bit more flexible. The Secured Act. So with this, a lot of folks, you'll have to excuse me getting excited over it. This is what I deal with quite a bit. So it is something that came out, was effective starting in 2020. And it has caused such a mess of things that have been really, the IRS has been ironing out ever since it came out. This is when RMDs come into play, which stand for required minimum distributions. They are distributions that have to be taken from retirement based accounts when you reach a certain age. So if you were born before 1960, it's when you hit 73. If you're born later than 1960s, when you hit 75. And for account holders, the amount that you withdraw is calculated by dividing the fair market value of your account at the end of the previous year by the what they call applicable distribution period, which really just means it's based on life expectancy. So the IRS publishes worksheets that you can look up and figure out, okay, here's my age, here's my life expectancy, here's what I have in my account based on last year, here's the amount that I have to withdraw. And for those withdrawals, the year that you reach the age of attainment, whether that's, I put 73, but it could be 75 depending on when you're born. The year after that, you have to take that required minimum distribution by April 1st. And every subsequent year, it's December 31st. A note is that with these RMDs, they only apply to the tax deferred accounts. They do not apply to Roth accounts. And basically, what tax deferred means is you get the break on the front end, you get that deduction on the front end. And as it's accruing in value, when you take withdrawals, you pay the taxes on the back end and you pay taxes on any appreciation as well. Roths are the opposite. Roths, you still pay taxes on the front end as it's ordinary income, even though you're contributing it to a retirement account, but you get tax preferred treatment on the back end. You don't have to pay income taxes on the withdrawals from those RMDs on that back end. So as far as that Roth option goes, and I jumped ahead a little bit, so here goes into the difference between the tax deferred and the Roth options. The Roth options with the Secured Act are available to more accounts. So Secure 2.0 actually included Roth options for things like SEP and simple IRAs. And depending on the employer, 401k options can also come in Roth options. And so a note on that is, even though they are possible, are they going to be common? Probably not. And the main reason is because since the Secure Act is the one that brought a lot of these to fruition, and it is still relatively new, a lot of financial institutions haven't adopted those types of accounts yet. They'll still have the what I'll call traditional SEP or traditional simple instead of a Roth SEP or Roth simple. And same with 401ks. So because the 401k, you get the tax break on the back end, you lose the tax break on the front end. A lot of employers don't see the point in offering a Roth option because they don't get the deduction. So yes, they're out there. Are they common? Probably not, right? If you come across it, consider it. but also speak to a CPA once again. They will help you determine if that's going to be the best fit for you. Oftentimes, what we find is if you want a Roth account, it's probably best to do it just as an individual account instead of, as an employer-based plan. Um, Going back to this previous slide, one other thing I did want to harp on is these RMDs. So if you've Googled them, you would know that the IRS has, even though they've been required, the IRS has waived the requirements to take RMDs. That is stopping in 2025. In 2025, failure to take RMDs from any of the accounts moving forward will result in penalties. So the reason they waived it for the past few years is because the law was so poorly written and it caused so much confusion. Compliance was difficult at best because nobody knew really what they were supposed to do. Moving forward, the IRS has said, okay, we've had a few years to work out the kinks. The latest update came out in the Federal Register, I believe it was July 19th of this year. So they're like, we've defined everything, best we can. You all should be able to figure it out from here. Starting in 2025, penalties begin. So keep that in mind. If that's something where, you looked at it a couple of years ago and you're like, well, they've just waived it, it doesn't really mean anything. Moving forward, it will. So if you're getting towards that age, down the road, look back into it and make sure what the penalties are for failure to take those. And so now we've all come to the big question. What plan is going to be right for you and your law firm? And I've gone with the tried and true, it depends. It can vary so wildly depending on how your firm is managed, how it's run, and a lot of factors within that. And so I've just put in a few factors to consider when you're looking at plans and talking about it, hopefully with a CPA or accounting firm. And so the first one is, how is your cash flow? Do you have funds to contribute to the plans right now? The next one is, and this next one might be the biggest one, is what perspective are you looking at it from? Are you looking at it as an employee, or are you looking at it as an employer? Because that handles the next two. That dictates whether you're going to mind the administration and the complexity in setting up and managing that type of retirement account. And it also dictates what taxes you're concerned with. If you're an employee, you don't really care if your boss's company gets a write-off. Good for them, but it doesn't affect you in the slightest. And so really that perspective is, which role are you more concerned with? And for you solo practitioners out there that are wearing both of those hats, that's a really potentially tough question for you because it can be both. That might have your personal taxes come into it. If you look at your own paychecks, if you're filing joint with a spouse, that's something that all of those factors come into play. And so just to run through a few examples and have a little bit of application to this, I thought I'd give us all flashbacks from law school. And I typed out just a few hypotheticals for people that are coming forward and looking at, what, my apologies for the noise outside, what plan is going to be right for them. So hypothetical one, let's just say you are a firm owner, you have multiple employees. Cash flow is a little tight. It's in the green, but there's not an abundance of extra funds. And you're wanting a plan to benefit your other employees. You're very altruistic. Your goal is to benefit them. You don't want anything too complicated or anything with additional filings. So you want to minimize the work. You want to benefit other employees. What accounts are going to be best for you? Well, after going through everything, payroll deduction, IRA, or a SEP IRA might be good. So neither of these on the employer's end have additional filing requirements. The payroll deduction IRA allows the employee to make the contributions. So since you don't have a lot of cash flow, the ball is kind of in their court if they want to contribute. And similar with a SEP IRA, there's no mandatory, even though the employer is the one doing the contributions for the SEP, there's no mandatory contributions. So both accounts are easy to set up and administer. They both allow flexibility on part of the employer. And even though they don't give the employer a big write-off, they still benefit the employees. And that may potentially be the best or one of the major goals for someone. Maybe they don't want the write-off. Maybe they're just being purely altruistic and wanting to set up something for their employees. So these may be good fits for that type of scenario. And I'll say there are other good fits too. This isn't a definitive list, but we're going to hit some of the high points. Hypothetical number 2 is you're a firm owner. You're at a medium-sized firm. All of your staff attorneys are highly compensated. They bring in plenty of clients, and cash flow is high. It will not be an issue for this foreseeable future. You've been chugging along. Your firm's been doing great for years. That won't dip anytime soon. Your firm is also already working with an accounting firm to handle payroll, bookkeeping, and the tax work needed. So you already have a group that you can delegate things to that's in place. And you're looking at something that can benefit your employees, but really because of the income of your firm, you're looking for something that can also mitigate the taxes that your firm is liable for. So very different than the last scenario. The last scenario, cash flow is a little tight, in the green, but not overly abundant as far as additional funds go. In this one, doing very well. And so a few different options for them would likely be profit sharing or safe harbor. So for both of these, they both allow the employer to contribute. For profit sharing, it's a may contribute, not a must, but it allows them a little bit of flexibility and allows them to deduct a portion of the contribution. So that deduction, again, is a high point. For the safe harbor, I'd also point out that neither of these, if you go back to the hypothetical, you have a lot of highly compensated folks. Neither of these require the non-discrimination testing, which is another reason that they may be a good fit. So for the safe harbor, the employee and employer can contribute, and you still get that deduction. Even though employer contributions are mandatory, you get that big write-off at the end of the day. And so because they get away from that non-discrimination testing, they allow for some flexibility, but mostly that big deduction. These are plans that might be a good option for a law firm in hypothetical number 2. And going back to the question that we had earlier, you can mix and match these. You can do profit sharing and safe harbor. You can also do payroll and SEP, or you can do payroll and profit sharing. So if it's not a one size fits all, you can divide and conquer based on what you think is going to best fit your firm in your particular set of circumstances. And hypothetical number 3, and this may fit a lot of folks who have attended this meeting. You're a solo practitioner. So you're someone who has just started out, or maybe you're fairly seasoned, but your book of business is still growing. And really what you're looking for is to maximize deductions for your firm down the road. You've been cramming in CLEs, and you know this new knowledge is going to just make your firm take off. You currently do your own bookkeeping, but you're not put off by the idea of doing extra work until you can hire a CPA. So you're looking for deductions down the road. Not a lot of cash flow right now because you're just starting out, and you're not too worried about the extra administrative work. So in this scenario, the two that come to mind would be the traditional 401k and the SEP IRA. So the traditional 401k does not require contributions once it is set up. It is purely permissive from the employer and the employee. And even though it does have, you would think it has the non-discrimination testing with a single employee, that really should not be a problem. And then with the SEPT, this kind of easy to administer and allows the employee to save. And you can do both of these at much higher limits than you can with a traditional payroll deduction IRA. So you can put in more. So if income jumps up, great. If cash flow is tight for a little while longer, there's no mandatory distributions. And so you still get the write-off as well. And so these are, again, by no means a definitive list. And for example, Hypo 3, if you went to a CPA and you read this Hypo and you think that fits me, and you go to a CPA and they recommend another strategy, go with the CPA. They are better able and positioned to look at the way that you run your firm, look at your cash flow, your overhead, income, other expenses, all of that stuff, and strategize what's going to be the best fit for you. And so these are just small examples as far as how these accounts can actually be applied and may work best for certain scenarios. But that I thought I was going to go over. Hopefully, I didn't talk too fast. But with that, that is it. And so let me see. I don't believe I have any questions in the chat. Are there any other questions or anything that maybe I should revisit?
Well, George, I don't think we have any other questions, but I'm sure you don't mind people reach out to you directly in the future if they have anything else they need to hear from you or have any questions about your material. Do you mind?
No, that's not a problem. If anybody wants to reach out, you can call TCV's direct phone number. It's 865 297 4070, or you can get me by email. It's ggilliam@tcvwealth.com. And one of the big things that we do, other than trust and estate administration, is wealth management. So we have quite a lot of retirement accounts included in that. So I'm more than happy to field questions if I'm able